Money Sense, bringing an informed financial perspective to the Cayman community.
Good morning and welcome to Money Sense. I am your host, Amy Hubble, and I'm joined in studio by co-hosts Adam Newman and Georgie Luxton. We are sitting an appropriate distance away from each other, but we are live on the air, and today, obviously, we're going to talk about the thing that nobody else can stop talking about, the novel coronavirus. And so if you have questions today, we are actually going to open the phone lines. That number is going to be 1-800-534-8255 toll-free. All right, so if you have any questions, go ahead and call in. If there's anybody still on the roads this morning commuting to work, or if you're listening from home, but we are just going to get into it. We only have 30 minutes, and there is a lot to talk about. Right, Adam?
Absolutely. Thank you very much, Amy. Good morning, everyone. Look, first of all, we hope you're all staying safe at home, and you know, this is very surreal moments. As a parent trying to homeschool two children, it's very surreal and you know, certainly tests the nerves. But first of all, I just want to say, look, just to make clear, none of us are medical experts here. We're here just to look at the impact of the coronavirus on the economy and finances, and hopefully give you some sort of practical advice and reassurance around you know, investments and outlook. Starting really, I mean, this is unprecedented. What unprecedented in terms of the speed of decline of markets. You know, only a month ago we were at all-time highs for many of the indexes, and within 4 weeks we have lost anywhere from 30, 40, 50% on some of the indexes and stocks, and some specific stocks have done much worse. We've seen a complete collapse in oil prices, falling more than half. Nothing has been spared. Gold, which people thought would be a safe haven, has lost a lot of value. Silver, even more. Crypto, which many Bitcoin people felt was going to be a store of value in the next crisis, has fared particularly poorly as well. So, you know, nothing has been spared except for the US dollar. And this tells us what we're experiencing at the moment is a liquidity crisis. Sure, the coronavirus was the tipping point, but valuations were quite extreme. We've had 10 years plus of central banks pushing liquidity into the system, and that's increased the system leverage in the system. And what's happened now is that the coronavirus has led to uncertainty, and everyone at the same time has rushed for the exits, and everyone tries to put money in the safest haven, which has always actually been US dollars. And we've also seen we've seen bond yields fall as well, which also has been a safe haven in times of crises. As I said, it's unprecedented. I think the speed of decline even surpassed that decline we saw in 1987. And right now it's fear that's driving the markets. And the problem we have is it's really hard to price risk at the moment because the world is on lockdown. We don't know when industries are going to open up. We don't know what this is going to mean for world trade, and the outlook's very uncertain. But that said, you know, this time will pass, and we will get through this, and there'll be better times ahead. And with tough times, always present some opportunities. So actually, what we wanted to try and do is be a bit more constructive and look at where maybe some of these opportunities may arise, what maybe the roadmap will be forward, going forward as well. So maybe I'll jump in and start with the fact we're in a deflationary period with industries shutting down, the economy shutting down, the US dollar rising. This is a very deflationary period, and governments and central banks around the world are going to try and reverse this trend. And we have seen already announcements of massive stimulus across the world, from the ECB launching further QE, same with the Federal Reserve, and pretty much most central banks cutting rates or providing stimulus. This only works in the short term in terms of unclogging liquidity. You know, this is not a long-term solution, just throwing money back into the system, but it's very important at this point that the system doesn't completely collapse. So this is a short-term solution. What we're going to see a lot more of is actual fiscal stimulus, and that's going to lead to a more sustainable recovery at the end of all this. So we have seen announcements by the EU, you know, individual countries providing, you know, budget for tackling the coronavirus. And I think that's where we might start to see some opportunity. The other thing that I did talk about was the US dollar. I think the US dollar is the single most problematic thing for the economy at the moment. And we have had a precedent in the past where the US dollar was devalued. I think at some point we're going to see some sort of global coordination to get the dollar weaker, because emerging market currencies are now at record lows versus the dollar, and if this doesn't change, then there's a lot of problems going on, in emerging markets and the rest of the world.
Yeah, no, and I think that's a really, really good kind of summary on that situation. When we talk about central bank action, that is almost not tangible for people sometimes, though, because obviously in the U.S., around the world, interest rates were already at near zero, if not negative. So really, what do you think, Adam, and Georgie too, as far as lowering rates, continuing QE? I guess the ECB came out last night and said they're going to buy, how many, $750 billion in euro bonds. What can we do at this point from a central bank action to really get rates lower? Are we all destined to go negative rates forever? I mean, I think the U.S., it looked like there was some pushback on that even yesterday, in some decoupling of the traditional relationship of yields going down if stocks are going down and prices going up if stocks are going up. It looks like people are selling out of the market and staying in cash, which was exactly what you were saying with U.S. dollars. So where can we go from here, stimulus-wise?
Look, I mean, I think that there is almost no limit to where central banks will be prepared to go in the short term. It was not long ago that a lot of the Federal Reserve Board members were saying that it's impossible to have negative yields in the US. We're not there yet, but we're basically at zero. Whatever it takes, which was Draghi's line back in 2012, is kind of where we are with central bank action now in the short term. The belief is that, we now need to follow that up with fiscal stimulus, which will hopefully bring bond yields back up as we start to see economic growth. But I think in the short term, we could see some further extreme action. As I said, this is about addressing a liquidity crisis, not a long-term sustainable solution.
And as you're saying, for the man on the street, what governments really need to do is get money into people's hands. I mean, as you said, central bank stimulus doesn't really affect somebody who's, working in the hospitality industry and has lost their job.
Absolutely. This isn't bad behavior on part of the companies. This is a situation where the whole globe is being forced to shut down. Yeah. And so, yes, that is the role of government, I believe.
But I think a good point around sort of this being unprecedented, and it is unprecedented in its speed. We've never had a bear market happen this fast. And, traditionally a bear market is defined when the market falls 20% or more. But where we are today, I think the markets are up today, so who knows what the percentage fall is. I mean, it changes by the second, but we're somewhere around 30%, Europe a bit more. That's not unprecedented, the fall from peak to trough. And I think that's a really important point for people to understand, that markets do this. It's completely normal for markets to fall 30% from the peak to the trough. In fact, the average fall from, I believe, the end of the Second World War for a bear market is 33%. So we're about in line with that fall. The question is, where do we go from here? And we don't have those answers. Nobody does. But the peak to trough decline is not unprecedented. The speed of it is, and that's what's felt so scary to people. And I just think we have to remember that this time is different, but every time is different. Every time the market falls, it's different in the cause. It was different when we had 2 aeroplanes fly into the Twin Towers. It was different in 1987. It was different during the Great Depression. But it's also never different in that we know rationally, and it's hard to be rational in the middle of a crisis. But 2 months ago we could have been rational, and we know rationally that the markets are going to turn around and come back up again, because that's what markets do every single time they fall. Every time. We don't know when that day will be, but we know that day's coming. And when it comes, it may come fast because of all the stimulus that's happened. So
and that's what we hope. In that the market, because it is so forward-looking, yes, we are probably. I mean, I certainly will say we are going to be in a recession. No doubt about that. At this
that's
point.
A given now. Yeah.
And it's a situation where the world is shutting down for a month, but the stock market is kind of always idealist. They're always looking forward. They're seeing what's going to happen. There is going to be some liquidity, some bailout money probably going towards some of those tourist interests. There's still lots of details to be pulled out, but that I think you make a great point, Georgie. And I know the radio listeners can't hear, but I'm sitting here like nodding my head right along.
I think Adam's nodding his head.
Yeah, Adam's our macro guy, so he's always looking at the flows.
But the other thing about
money.
recession is the recession word is so scary for people, particularly because we haven't had one in a really long time. But again, recessions are really normal too. You know, recessions are a normal part of economic growth.
And they're good in some respects. You know, they teach companies to be, you know, a bit more efficient with their cash, to be running them in a different way, in a more productive way. Yeah. So actually, you know, this is a bit of a cleansing. I guess in the short term, what I'm personally looking for to sort of see a more convincing bottom in the market is to start to see those case numbers fall, you know, globally.
Absolutely.
I think, or at least the growth of case numbers. And I think the issue we have in the very short term, because Italy's looking more promising, is that the US is still a few weeks behind. So hopefully in the next few weeks we might start to see the growth numbers in the US, case numbers falling. I think that will be, you know, the first sort of very positive signs. I think, you know, we're obviously going to start to see news around vaccines, and, you know, although they may not be coming to market, you know, that should.
And the treatment protocols. I mean, a vaccine will come.
Absolutely.
Yeah. But the treatment protocols are becoming better and better. The doctors are, you know, finding what works and what doesn't. And that wasn't the case even 2 weeks ago.
Yeah, and I'm obviously American, and I have seen a big change in the reaction of people I'm communicating with, people that I'm following, in how they are now dealing with this from even over the last weekend. You've really seen people now buckling down, staying at home, schools being canceled, restaurants being canceled, which is obviously not a good thing. But the faster that we can take some of these, in many cases, and you see it in Cayman, obviously, some of these even draconian measures that we are shutting the airport down, the faster this gets over with, right?
Agreed.
So it's a deep, sharp, fast shock that, you know, may result in, well, it will result in Q2 being a complete write-off, and maybe Q3, but then we're probably going to see some strong growth.
But if we could contain it to Q2, I think that would be a really
best
good
case
thing.
scenario.
And with all the stimulus, by the end of the year, you know, the economy could be going gangbusters. So
Can you imagine? I mean, just human pent-up demand from
people
being stuck inside.
Immediately going to eat out 3 meals a day and go on vacation.
It's very true, actually, all those things that you wanted to do and you put off and stuff.
Yeah, all these airline credits that are going to be built up, and obviously the airlines are going to drop prices. Hopefully over the summer we can get back out there and move around. But that doesn't necessarily mean that we will recover as fast as we've dropped, certainly. So I think that is something to be mindful. But and we can talk about this a little bit later, just in terms of there are opportunities for the everyman on the street. If you do not own a house, if you have a home loan that maybe is on a variable rate, you can refinance to a fixed rate. Very, very low rates, not just low rates on a historical basis or the lowest rates in our lifetime. This is the lowest rates have ever been in the history of ever. Am I wrong?
No, absolutely. So, yeah, there's opportunity. Now, I'm hearing we have actually got a caller on the line, so should we open up the lines?
Hey, let's do it.
Good morning, Simon.
Simon is actually trapped in the UK for the next month, but you are on with Adam and Amy and Georgie. Go ahead.
Oh, okay, I thought it was Simon. Okay, good morning, Mario Eubanks here, Dr. Amy. How are you today?
Oh, hello. I'm very good.
Good morning.
Good morning, Adam, and morning.
Hi, Mario.
It's Luxton. I really enjoy your writings that you send out every week or so as well.
Thank you for reading them.
It's a lot to read, but it's good stuff. So, just a couple of quick questions, and thank you all very much for doing this. And it's very timely, and I always enjoy your show. As a matter of fact, a couple of years ago, I encouraged Simon and others to do this show. So I'm very happy to see this. It's still there and doing very well and very, very, very helpful. Just in terms of the market, of course, I don't want to say too much. I know you don't want to say too much either, because we don't want to get people even more nervous, because I know there's a lot of anxiety right now in terms of what's happening in the markets. But what do we say to people when they look and see their portfolios going a bit crazy, and then in the last couple of years people have seen their performance unprecedented highs, and also with the pensions the same thing. It's been after the meltdown in 2008, 2009. It's in the last several years, pensions have grown with significant gains, and so the question is, how do we help reassure folks of their long-term outlook? And the second point of question is that I've been listening and watching the global commentary about the markets, and the U.S. is about to inject a stimulus of about $1 trillion in the U.S. economy to help to cushion some of the impacts of this coronavirus global meltdown. But they're suggesting that it probably needs to be more like $4 to $5 trillion, but to really make an impact, and that may also positively impact the markets. I'm not sure what your thoughts are on that and how that would impact. And the final point is that there's been some suggestion about potentially having people in Cayman access some funds in their pension plans as a kind of short-term cushion for business and financial cushion, or maybe some kind of pension holiday and stuff like that. Again, I just want to get your thoughts around that as something that, whether that's going to be good for the market, good for the economy, or some short-term gain for long-term pain. So just, I don't know, a lot of questions and comments got in there, but I'll leave that with you because I know you were able to handle it. And I thank you for your time again, and good morning to you and all of our listeners.
Thank you, Mary. Appreciate the question. We're just going to jump to a break, but we've got your questions, so we'll answer those questions straight after the break.
Sure.
Thank you.
Thank you, too.
A public service announcement from Radio Cayman. Coronavirus prevention tip.
For persons who think they may have symptoms, you owe it to your family, to your friends, and to the community. You have a moral obligation, if you think that you may have been exposed, to withdraw from community activities and to stay at home until a safe period has expired. The elderly among us are particularly vulnerable, and not isolating in many instances will be the same as imposing upon those people a death sentence. Please understand the seriousness of that. We are encouraging everyone to be as responsible as you can possibly be during this very, very difficult and critical time.
For the latest updates and information, please visit hsa.ky/public-health/coronavirus or gov.ky/coronavirus.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Excellent. Welcome back, everyone. Just before the break, we had some great questions, so we're going to, between us, try and answer those now. So perhaps Georgie or Amy, you want to...
Yeah, well, the question was really, how do you help people when they're looking at their portfolios and every day they're going down? How do you help people be focused on the long term? And it's such a hard question, and psychologically, we humans understand the long term, but we don't live in the long term. We live in a series of short term. Right. And at this minute, we're, slap bang in the middle of a really, really tough short term. The advice that I've been giving to my clients is, when we think about the stock market, it's the only thing that we buy where when prices go down and things get cheaper, we want to sell. If you think about anything else that you buy in the economy, you walk into your favorite store and, things have got 30 or 40% cheaper, you buy those things. In the stock market, we want to do the complete opposite. And we have to remember that today, stocks, companies, remember these are companies. They're 30, 40% cheaper than they were a few weeks ago. The last thing we want to do at this point is panic and sell. Then we're buying high and selling low. And we know we want to do the opposite. And it's very unsatisfactory in some ways to tell people to, stick with it and stay the course and focus on the long-term game. But there's nothing better that we can really advise people to do. It's sort of Winston Churchill, I always use this quote, said that democracy is the worst form of government except for all the others. And it's sort of the same with the advice to stay put and focus on the long-term game. It's really unsatisfactory, but there's nothing better. And I think, if you have a portfolio, just don't look. Honestly, don't look. I think if you've got someone helping with you with your portfolio, ask them to let you know when it's safe to look again. And, there are more important things to be doing. And if this money is for decades out, which it is for most people in their pensions who are working and saving and investing for retirement, like Amy said earlier, we don't know what's going to happen in the next 2 or 3 weeks or 2 to 3 months. But you're not investing for the next 2 to 3 weeks or the next 2 to 3 months. You're investing for the decades to come. And we know, again, rationally, that in 10 years, 20 years, 30 years, the market's going to be higher than it is today. And your long-term plan is still intact.
Absolutely. I echo every single thing you say. And I think a lot of times, even as investment advisors, we get nervous too. And especially when we start hearing things and it's some sort of like, well, why didn't you see this coming? Well, of course, obviously, none of us could have seen this coming. But in the long term, even in your pensions, I mean, the way that you're invested, your blend between stocks and bonds, a lot of you are appropriately invested in a lot of bonds in the world too, which are growing up in price, and that's by design. And that's why you keep those bonds and those low risk assets within your portfolio, because it does help to hamper some of that volatility in these times that come. Like Adam said, like Georgie said, this is not a drawdown that we've seen for the last 12, 13 years. So it's like we do have lost our memory a little bit, and we'll say, okay, next time I will for sure do better about this. I will always be invested correctly. But we will come out of this, and there is no way that you are going to be correct in picking the bottom and picking the top. You have to be right too many times. So if you are a long-term investor, I agree 100%. Don't look at it. Stop watching financial TV. Leave that to us. And
remember, if you are saving for the long term for retirement, then the fact that everything's 30 or 40% cheaper today than it was a month ago is great news.
Absolutely.
Right? If you're still buying, which you are, if you're putting money into a pension, if you are still buying stocks, then we should be welcoming lower prices today, assuming that you don't need that money tomorrow or next week or next year.
Yeah, a great opportunity.
Is there also a sort of case to say as well, you know, now is a good chance to upgrade your portfolio? Perhaps there were some stocks that you thought were a little bit expensive and chose not to buy, some really high quality stocks, and maybe now you can actually buy those stocks at a price that you feel more comfortable with. Yeah,
I mean, if you're out there and you're stock picking, then that's a tricky one. I mean,
I do believe that certainly stocks have been indiscriminately taken out into the street and beat. And certainly a lot of those deserve it. The airlines, the cruise ships, the hotels, the restaurants. But there's a lot of good companies out there that really, in a long term, yes, there's going to be some demand delay. I mean, because everything in our economy is connected, right? If one person can't pay their bills, then they can't buy that service, then they can't, and it goes along. But there's a lot of companies like Target, Walmart, things that are continuing to be used, even food delivery services. I mean, there are a lot of companies in this economy that will thrive. There will always be an opportunity. But in those situations, I'm kind of with Georgie too, is look long term. Don't try to pick up what's going to be doing well in the next 2 weeks, in the next month, in the next 3 years, in the next political cycle. Your own portfolio is specific to you and your needs and how much risk you can take and how much yield you need to have for your own situation to save for your retirement. So I would encourage you to stay calm and to stay confident if you are already invested, and if you have some cash on the sidelines, maybe throw a little in.
And remember, my last point here before we get on to the macro question is that doing nothing is a decision, and it's a really good decision today. Doing nothing when doing nothing is the right thing to do is very wise. And my advice to most people today is that the right thing to do is nothing.
Sage advice.
Excellent. So on to the macro question, and this actually I think leads also, maybe we can come back round to some opportunities in the space. It's interesting, out of a crisis, actually some good often comes, and politically, the US, particularly focusing on the US as it's the most important market and tends to drive all others. Politically, there's been a lot of gridlock, to stop certain reform happening. Now this crisis, I think, opens up that it'd be far more acceptable to do some, really big stimulus where it's needed. There's a lot of infrastructure upgrades that could happen in the US. I really don't think we're going to see a cap of 1 trillion. I think, whatever it takes, back to that phrase from Mario Draghi, the US will spend to get the economy going again. And that could be 5 trillion of stimulus. Part of that will go straight into people's pockets, I think, after the previous crises, when perhaps there's a feeling that corporate America got bailed out and Main Street lost out. I think this time people are going to be very careful. We're talking about money, literally paychecks being helped to support those families that most need it, and they will go out and spend initially, and then we'll have that trickle down effect. I think there is a case, that there's certainly going to be upgrades done in the medical healthcare space, building of hospitals. Hopefully that leads to employment of, nurses and other professions around the medical industry, upgrades of roads. Technology, I think, is an interesting one. I think, the US, again, I think falls behind some parts of the world in terms of the infrastructure there. People may have realised that working from home, a lot of mobile companies have been overloaded with pressure from calls and data and stuff. I think we'll see some upgrades there, maybe in 5G technology. So I think that presents some opportunities. So from the macro point of view, back to the question, I think we will see way more than 1 trillion of stimulus being done, and again, whatever it takes. I think it will finally go down to the parts of the economy that most need it, targeting those families that most need it, and we will have a real chance to upgrade stuff that should have been upgraded a long time ago. And we'll see that across the world. Germany has been reluctant so far, in the last 10 years to particularly spend. They've wanted to remain within their budget, but now they will be spending more money on, again, services and industry that really need it. So from that point of view, I'm pretty positive. I think, there's potentially the pent-up demand, which Amy spoke about as well, that we'll see later in the year as the economy gets moving, as this money gets spent. We might see commodities doing well, oil and gas, oil prices, record,
it's a different
lows.
show.
It's a different show, but we're not going to stop needing oil. And there's a lot of oil companies, we're going to have a cleansing, companies will go out of business. But at the end of it, which always happens because we always go through these cycles, supply will get cut so much quicker. And then we'll probably end up with a problem that we'll cut supply too much just as the economy's booming again. So there's probably some interesting opportunities if you understand the space well, that some oil and gas companies probably trading at ridiculously low valuations. So that's not advice. I'm just saying that there are opportunities always through this. I think interestingly, and I haven't thought this through fully, but there'll be some structural changes, be it politically, socially, that lead to investment opportunities. Things like teleconferencing companies that have done particularly well. We've all worked out that we can actually work from home maybe more often than we had before, and so maybe teleconferencing becomes a bigger thing. Maybe we don't have to go to all those conferences every year. So people's habits will change, and with that comes some opportunities and innovation, which we will see.
And a happier and healthier planet.
Yes.
Because if people stop travelling so much, we're going to see a great impact on climate change.
Yeah, Adam, let me ask you this, and this was just something I was wondering as you were speaking of, in terms of the U.S. offering stimulus, basically turning on the printing presses, I don't know that will be too inflationary just because there is so much demand for U.S. dollars. But what about the rest of the world? The rest of the world that does not have the demand for their own currency to be able to just print at will, send checks to the people. What happens inflationary to those smaller countries or smaller currency blocks in terms of stimulus?
Well, at the moment,
is this deferred inflation?
This all depends on the US dollar and if they can get the US dollar under control. And by the way, a bit of inflation is positive, from where we are now. So I think if the fortunes of the US dollar reverse, and we're talking about pent-up demand, that some of that demand will be coming from emerging market countries as well.
Yes.
So hopefully we can turn back into an inflationary, have a sort of more inflationary environment. And that really needs to happen with the devaluation of the dollar. I think we're going to have to wrap up there. It was a lot to get into 30 minutes. Hopefully we've helped allay some fears and reassured people around some very difficult times. We're living in some very surreal times. So with that, I want to say thank you to Amy, thank you to Georgie for coming on, and you can always message in on our Twitter handle, and if you want to ask any further questions.
Absolutely. And a recording of today's show will be rebroadcast on the CFA Society Cayman Islands webpage, as well as your favorite mobile podcasting platforms. And we encourage you to, again, tweet us at Money Sense Radio. And again, thank you very much, and we'll see you again in 2 weeks' time.